Good afternoon, beginning options traders. This is Scott Gillum with the beginning options lesson number 6 in the series, the butterfly trades. All right, before we begin, let me remind everybody that all rights are reserved and copyrighted for 2022 for ShadowTrader. This means the content in this presentation is presented for educational purposes only. It should not be considered as a recommendation to buy or sell any security. Therefore, the information in no way should be considered investment advice. Trading options involves risk and may not be suitable for all investors. All rights and obligations of the options instruments should be fully understood by you, the individual investor, before you enter any trade. All right, butterfly trades, also called winged trades. So for this lesson, we're going to talk about a few different types of winged trades. Typically, the butterfly trade is either a long butterfly or an iron butterfly, short butterfly, basically. We'll also talk about, briefly, the broken wing variants to the typical butterfly. So let's go right into it. Winged spreads. Think of a butterfly. It's got two wings and it's got a body. Keep that picture in your mind. The butterfly type of trade optimizes typically a stagnant trend. When I say stagnant, that means that it will end up at a certain point on its price chart. The Greek that we're looking to have this be stagnant on is delta. So it's a delta neutral type of trade. Here is the caveat to that. Have a target price in mind when placing any winged trade. Always be aware of your body and your target price to where the equity or underlying could migrate to. This is going to determine the strike prices that we use. Two types of winged trades are the long winged and the iron winged. We'll go through those and give you some very specifics. All right, the long butterfly. It's a debit trade, which means what you pay is your risk. It can either use the call side of the options chain or the put side. Here's a kind of a suggestion. If you're looking to put on a typical butterfly, mock it up on the call side and also mock it up on the put side. You're not going to use the same strike prices, but mock it up on both sides. See which side of the chain is more advantageous for you. All right, going back to the structure. A long butterfly debit trade using either calls or puts. We've got three different strikes that we use. We've got a long strike for one wing. We've got a short in the middle. That's 2 times on the short. And then we've got another long option for the other wing. So it's 1 by 2 by 1. The other type of winged trade is called an iron butterfly. This typically becomes a credit trade. You get paid up front for a greater risk if you're correct. Here we're going to use both the call side and the put side as our instruments. We've also got 3 strikes in the iron butterfly, but we've got a long call, we've got a short call, we've got a short put, and we've got a long put. those two shorts in the middle are essentially the same strike. The structure should be all options being in the same expiration month, so everything works in concert with each other. We choose the strike prices based upon a number of factors for each type of strategy. Commissions here, because you've got 3 different strikes and 4 options on each one, commissions are of concern. So let's take a look. Comparison. 3 different strikes, right? Generally, a butterfly yields less risk, less money paid, a higher reward if you're correct. But if you're right on both, you're risking less for a higher reward. Your probability of success is going to be limited on the typical butterfly. So, for the long butterfly, remember, using calls or puts. It's a debit trade. Generally, we look at this being in the money or at the money, or a specific price that our short strike will be at the money, at or close to expiration. Now, on the iron butterfly, we're using both the put side and the call side. It's a credit trade. Hence, we risk more than we can make. Here we are looking at an out-of-the-money situation, looking for the equity price to move towards our short instruments. The long butterfly, or simply just a butterfly spread. Expectation is the stock is going to remain stagnant or attain a certain price level. That's called pinning. Equities trading at 100, I expect it to be at 110 on expiration of, let's say, the next week. Those are the short strikes that I would be using in this example. We can either use the call side or the put side. It depends on which is more advantageous. Remember, you've got a long option as one of the wings. You've got 2 short options in the middle as the body, and 1 further out long option as the other wing. The makeup of a butterfly is this. We've got a bull call. I buy a long call and I sell a higher up strike call. That's a bull call. That's a bullish vertical. I put that together with a bear call to where I sell the same strike that I sold on the bull call, and I buy a strike higher above that short strike. So it's a combination of a bull call vertical and a bear call vertical, where the short strikes are at the same value. Again, long call, 2 shorts, 1 long. On the put side, the put butterfly, same type of situation. I have a bull put where I buy a put and I sell a put at a higher strike. That's my bull put vertical. Plus the bear put where I sell the put at the same strike as before, and I buy a put at a higher strike. So a bull put plus a bear put with the short strikes at the same level. Once again, long put, 2 shorts, and a long put. Here's what it looks like on a P&L graph. I've got my long option, I've got my 2 shorts, and I've got my other long option. I make money if the equity price stays within this triangle. My break-evens are right here on one long option and here on the other long option. This is a debit trade for a conventional butterfly. Buy a long, sell 2 shorts, buy another long. I pay to play. Therefore, the debit is my maximum risk. That's all I can lose. The maximum reward. Well, it's the spread with the greater difference. So if these are not equal distance between each other, let's say here's a 10, here's a 15, and here's a 20, that would mean that my distance between the long and the short is 5, and the short and the long is 5. They would be equal distance. So the maximum reward spread with the greater difference between strikes if they're not the same. How about break-even points? Well, the break-even point is on the lower side. It's the lowest strike, which is this one, plus the debit I paid, which puts me right at the 0 line. On the upper side, it's the other long option that I buy minus the debit. So you can see that I am squeezing my profitability inside of this triangle. First option plus the debit, the other option minus the debit puts me inside of a triangle or a cone of profitability. If the stock ends up at expiration between those 2 break-even points, then your trade is profitable. The maximum profit that you can get is at the short strike on expiration. What's the probability, though, that this is going to happen? Well, as the other slide said, it's a low probability, probably much less than a 50-50 chance. Yet, we can work this. The wider the strikes, the more debit I take on, the higher the probability of success I have, but I have lower profits. The longer the expiration, the lower the cost to put this trade on, yet that brings in a lower probability because the equity can move up and down quite a bit, but it also affords me more profits. So you have to kind of weigh the debit, the probability, and the profit equation to something that makes sense when you put on a butterfly. All right, general setup. We expect the equity to end up at a certain price. This is called the pin price. One thing of caution, though. The standard play on this butterfly, we usually recommend, avoiding news or earnings announcements during the time of the trade. They can destroy the trade quickly. Avoid equities with very high implied volatility. They move a lot, which means your precision as to that pin price needs to be much greater. How about selecting those strike prices? Well, we select the short strike where you expect the equity price will be at on expiration. Usually it's at the money, current at the money price. But it can be anything on the spectrum. Typically, the long option strikes are 1 or 2 strikes away from the short, above or below that expected closing price that you use for the short option. The time frame involved, 30 days or less, is recommended. I would say if you can go 9 days to 1 day and get some precision in your execution, you're doing yourself a much better favor for probability of success. All right. What's the primary exit for this butterfly trade? Well, the best one is that it, on expiration, this butterfly has the short strikes at the same as the equity price upon expiration. You make your maximum profit. As that's a low probability, a better option may be when you get a good percent return, say 25, 40, 50% return on your debit a few days before expiration. Now, why a few days before expiration? It goes back to the Greek called gamma. Gamma is the gas pedal that is going to move the delta Greek up or down very, very wildly as you get closer and closer to expiration. As price changes, this effect of gamma on the delta, which is on the option pricing, says you should start looking to close a few days before expiration and work on this percent return. How about some secondary exits? Well, if things aren't going your way, the equity is not moving correctly, you could close at those break-even points that I talked about before. If it's absolutely not working out, you could close this at a percent net loss. In a bearish trend, an additional option could be added to make this into a ratio spread, or you could take possession of the stock itself and collar it. You could roll the trade out of the money and further out in time. Very low probability of success on this last one. Now, in a bullish trend, you could add another long option and turn it into a ratio spread once again. Roll the trade out of the money and further out in time. That's tough to do. That gets a little bit logistically tougher to do. So, let's take a look at what it looks like. All right, here's an options chart. It's a different platform, so don't worry about it. We're going to use the September options. This equity is trading at 77.55. We're going to take a look at the 75 call as one of our wings. We're going to buy that wing. Then we're going to go up to what we think our equity price ending on the expiration of this butterfly will be, and that's the $80 strike. So we sell one. No, we sell two. Then we go up another set of strikes to 85 and buy that wing. A long option, wing number one. long option, wing number 2. In between my 2 shorts. I've got $5 of potential here. I have $5 of risk here. So it's a 75, 80, 85 call butterfly. I buy the first wing at $6.90. I sell 2 for the body at $4.35 a piece. I buy the other wing at $2.68 for a total debit of 88 cents. My maximum risk is that 88 cents. My potential return. Okay, what's my potential return? Can you figure this out just by the numbers? Sure you can. If we end up at $80, what do I have? Well, I've got $5 of profit here, and I've got something else going on here. I've got a loss of money because I sold at 80 and I bought at 85. So it's the spread minus the debit. I've got a $5 spread minus the 88 cents. So my maximum profit at the $80 close on expiration would be $4.12. How about my break-evens? Well, it starts losing money or gaining money at these break-evens. So my lower strike of 75 plus my debit, so 75.88 is my low break-even. My high break-even, where I start to lose money, is 85 minus the 88, or 84.12. Just math, folks, just math. Okay, let's move over and take a look. I said, evaluate the call side, evaluate the put side. All right, we feel that there's a chance it's going to end up at 80. So I can use the put side as well as the call side. So let's take a look at that one. One wing is going to be at the 75 put. That's below the price. So that's an in the money. To make the bull put, I sell the 80 strike put. Well, I sell another one of those and I buy an 80, pardon me, I back this up. The 75 put that I bought, I always get confused the way that the strikes go. Let me back up. The 75 put that I bought is an out of the money. This is the out of the money. This is the bear put situation. I'm then going to sell my body of the 80 strike, which is an in the money. I'm going to sell 2 of them. And I'm also going to reduce my risk, cap off my margin, and buy the 85 put. I've got an out of the money put, I've got an in the money put, and I've got essentially an at the money put times 2. Let's take a look at the makeup. Once again, 75, 80, 85 put butterfly. I've bought the 75 put. I've sold 2 of the 80 puts. I've bought 1 of the 85 put. I now have a debit of 90 cents. This one costs me more than the call side. My maximum risk is that debit of 90 cents. My maximum return, okay, it stops, ends at expiration at $80. Well, again, it's the spread minus the debit, or $4.10. In this example, the call butterfly is better than the put butterfly based upon my risk and my potential return. Break-evens, once again, the lower strike plus the debit, and the higher break-even, or pardon me, the upper break-even is the higher strike minus the debit. So they're kind of a 50-50 situation, puts or calls, for the regular long butterfly. Now let's go on to that one that uses both puts and calls, called an iron butterfly. Once again, expectation. It's a butterfly trade. We are looking for an ending point on the equity at our shorts. Stock to remain pretty stagnant to where we can pick that end point. The structure. We've got a long put. We've got a short put. All right, again, there's your bull put. The short put is at a lower strike price than, this is a bull put. So a long put with a short put. Then we've got the other side using calls. We've got a short call and we've got a long call. This is the bear call side to the iron butterfly. Once again, the iron butterfly is a bull put plus a bear call, where the short options are at the same strike. Once again, it looks exactly the same as the regular butterfly, but instead of using just calls or puts, I'm using one side is calls, one side is puts. The long instrument, the other long instrument, the two shorts. A long call, a short put, a short call and a short put, and then a long put. This is a credit trade. We get paid up front. We get our credit in our pocket to start with. But we then assume more risk that it goes outside of this cone of profitability. Once again, the maximum risk is the spread with a greater amount of risk. But if they're the same on both sides, it's just the spread minus the credit. Break-even points, essentially the same as the long butterfly. Our lower break-even is the short put strike minus the credit. Short put minus the credit. Our upper break-even is the short call plus the credit. So short put minus the credit, short call minus the credit. If the stock is between our break-even points, once again, inside of this triangle, this cone, the trade is going to remain profitable for us. The maximum profit, once again, is achieved when the stock, or if the stock, ends its day on expiration at the short strike of both the call and the put. Okay, comparing the long butterfly to the iron butterfly. Once again, here's our long butterfly on the call side, our long butterfly on the put side. So let's use both calls and puts. Okay, on the long put that I'm going to use the 75 long put out of the money. I'm going to sell an in the money put at the 80 strike. Once again, 80 was where we expect this equity to end up at expiration. So my put side is a 80 strike short put, a 75 strike long put, my bull put. On the call side, I'm going to sell the 80 call because that's where I think it's going to end up. And I'm going to buy the 85 call. Once again, here's my bear call spread. Credit, credit. Same expiration on the shorts. Now, it's still a 75, 80, 85 iron butterfly, but we've used the calls and the puts. So I bought the 75 put for 430, and I sold the 80 put for 675. I sold the 80 call for 435 and bought the 85 call for 268. I now have a credit of $4.12. It's the same as the maximum potential on the regular butterfly or the long butterfly. It's essentially the same as the maximum potential on the put butterfly. Looks too good to be true, right? Correct. It's all predicated on that 80 strike price being the end price on expiration. You run the risk of this going the other way. Going the other way. All right, our maximum risk, spread minus the net credit. Well, my maximum risk is 88 cents. I've got a $5 spread. I got paid $4.12. My maximum return is that $4.12, just like the long butterfly. This seems to be the better of the two trades to work. I will tell you it doesn't work out that way. Probability of your iron butterfly getting you anything close to this maximum profit is far less than the long butterfly on the call side or the put side when you in real world trade this instrument. Okay, my break evens. The lower strike plus the risk. Well, the lower strike is 75 plus the risk of 412. The other break even is the higher strike, the 85 minus the risk. Break evens are essentially the same, or exactly mathematically the same. The probabilities of success are the thing that differentiate the long butterfly versus the iron butterfly. All right, how about some exit points for the long butterfly? Stock continues to trend. It goes to my short strike. I have a primary exit, percent return, or maximize the profit at the short strike. A secondary exit, as this is a very jumpy type of trade, close early. Take profits when you can at a percent return on your debit. Now, if the stock stagnates, well, if you did this as an at-the-money type of butterfly, you'll be okay. If you did it to the point where you're inside of the break-even points, you'll be okay. You can go to your primary exit or your percent return. My suggestion, if the equity stagnates and doesn't make it to your expected short strike, that you continually monitor this and take profits early. What if it starts to go the other way, either above or below your break-even point, which means that it's outside of that cone of profitability? It goes away from those long strikes. A close at a percent loss makes sense. As it's a small debit trade, you may want to just ride this into expiration. And this goes for the debit only. A better suggestion would be to close this early to minimize the loss, or maybe even be break even. This is an intensively needed, this trade is intensively needing watching to see which way it's going. All right, that's it. Now that's on the debit butterfly. On the credit butterfly, or the iron butterfly, as you trend away from the long strikes, you are running big risk. Much bigger risk than you want to afford. Again, the debit butterfly is the one that I would recommend you start with. And as you get more adept at picking the right strikes and this type of trade, this wing trade, then you can venture out to the iron butterfly. All right, folks, that's it. The lesson on winged trades. Thank you very much.